Let's pull the focus, though, to property, to the housing market. So what impact will the recent and potentially future interest rate cuts have for property investors? Anthony Landahl from Equilibria Finance joins me now. Hello, nice to see you.
Nice to be here.
So what kind of conversations have you been having in the wake of that cut last week?
Yeah, look, I think for property, I think for investors more generally, we're going to see a lot of investors looking at opportunities. Obviously, we're seeing deposit rates under 5% now. So more broadly, I think we're going to see a lot of activity from institutional investors, maybe around the REITs. They've been returning over 13%, as well as commercial properties coming back a lot, which is great in terms of they were in quite a lull. Last week we saw Goodman deploy $4 billion, and that was snaffled up by institutional investors. So I think more broadly investors are looking at opportunities with deposit rates and cash obviously decreasing. Bringing it back to mum and dad investors, it's going to impact on two fronts. We've already seen investor credit flows up about 13% over the last 12 months. So there was a lot of activity. But for new investors trying to get in the market, obviously lower rates means it's cheaper to get in the market.
Well, it is. It's not a massive impact. But it's psychological, isn't it?
Yeah, I think there's a psychological impact. I think the other impact is for those existing investors who've had a lot of cash flow challenges. They'll start seeing some light at the end of the horizon. In terms of holding their properties, we've seen some investors selling off. I think some of those investors might be now thinking we can potentially hold that property. The risk obviously is a bit of a herd mentality where investors are going, hey, we're going to see more rate cuts, cheaper to get in the market. That might actually stimulate the market. And we've seen some commentary recently around, there's been a slowdown, particularly in Sydney and Melbourne, that these rate cuts, the first rate cut and potential future rate cuts, might actually stop those slowdowns and stimulate some investor activity, pushing demand and potentially prices back up.
So demand, but what about the supply side?
Yeah, supply is the problem. It's been a chronic issue, as we all know. We had a funny situation where rates were going up rapidly and cost of housing was going up at the same time, essentially, which is very counterintuitive, and that's all about supply. We've had issues around construction, we've had issues around immigration, and obviously very, very tight vacancy rates. And during that time, investors were out of the market. Investor credit flows are back around $30 billion a month. That's back to 2022 levels before we saw those rate increases. So supply is the big challenge, no matter how we look at it. That target of 250,000 new homes a year, we're at about 163,000, so we're 30% below the target, and construction still has a lot of challenges despite there's some initiatives by state government. At a federal level, they've just announced some restrictions around foreign investors and stuff like that as well to try and help the supply side.
It's just such a vexed issue in this country and other countries as well, in fairness. Yesterday, the ABS said that rents rose 5.8% in the 12 months to January, following a 6.2% rise to December. But easing rental price growth, it says, reflects recent increases in vacancy rates across most capital cities. So what are investors getting in terms of yield? Yeah,
gross rental yields are still pretty strong. They're above pre-COVID levels, well and truly. Nationally, gross rental yields for the major capitals are sitting at 3.5%. The regionals were a little bit higher at 4.5%. The regionals often are a little bit higher, but the capital growth might be a little bit less. So yeah, your gross rental yields are sitting anywhere between 3.5% and 4.5%.